Experts predict the U.S. housing market is on the brink of a major decline. Now, the drop in home prices is expected to be the second biggest since the Great Depression.
Mortgages are continuing to collapse, and economists say the housing market in major cities could see home prices drop by as much as 20%. Here to discuss what this can mean for buyers and sellers is co-host of the Odd Lots podcast on Bloomberg, Tracy Alloway. Welcome, Tracy.
Thanks so much for having me.
So help me understand. My perception was that so much of the high housing costs right now were driven by the supply chain crisis, the fact that many people were trying to do renovations and the like during COVID, and that combined with the fact that people just couldn't get the goods, principally lumber, to complete their projects. It was driving up the cost of house building and exacerbating the supply issue that has been long existing. Is that not still an issue? How does that factor into this prediction that home prices are actually going to fall?
Well, I think it was a big issue for the past 2 years. And in fact, if you look at a chart of housing starts versus finishes, you can see the gap between those two really widen. And that is because of the supply chain issues that you just described. It took much, much longer to actually finish houses. But that said, the U.S. has a structural shortage of housing. And that is really, leading to some of the higher house prices that we've seen over the past couple of years. That combined with, demand for work from home space, lots of people moving out to the suburbs. So you have this big demographic shift. Now, that said, the key question as we enter this environment of higher interest rates is whether or not things are actually different this time, whether or not the structural shortage of inventory is going to be enough to offset the negative impact from those higher interest rates.
Well, but help me understand this then, because, we talk a lot on this program about the downsides, obviously, of having housing prices be too high. It's harder for people to buy. I certainly understand that somebody who owns a house doesn't want to see the value of it decrease at all. They want to see the value of it go up. But is what you're describing, that sounds like it could be, in some sense, a good thing, or making it easier for people to buy homes.
Well, that's what you would sort of hope. You would hope that first-time home buyers finally get a chance to come in and buy at a lower price point. A lot of people, a lot of millennials, of course, have been waiting in the wings for more affordable house prices. That is not, unfortunately, what we have seen so far as interest rates head higher. In fact, we've seen housing affordability, so that's, the cost of a mortgage, down payment, tempered by average salaries. We have seen affordability deteriorate at the fastest pace on record, which is really stark and unfortunately is a huge negative for people who are hoping to get on the housing ladder in this environment. It basically means that so far, the increased cost of mortgage rates has outweighed any softening in actual listing prices that we've seen in the market.
Yeah, that's what's so confusing about this story. It does seem ultimately that, I think that Robbie's point is right, that if in fact demand continues to be so high because of these legacy issues that we have with new homes not being built, it's hard to imagine what would incentivize home prices to drop when there are, however many people looking for homes versus how many homes are actually being built or available on the market. And I wonder, can you speak to whether or not the fact of so many venture capital funds, kind of Wall Street banks buying up housing property, how, if at all, is that affecting these dynamics?
Yeah, so I know the story about private equity coming in and scooping up single family housing has been a very popular one, especially in financial media. That said, a lot of the investment owners, people who buy houses purely for investment, like that category also includes, just an individual who might buy more than one house in order to rent it out. There are a lot of baby boomers, for instance, who've been doing that. But now you mentioned legacy issues, and that is a really good way of putting it, because a lot of what we're seeing now is basically the aftershock of the 2008 subprime crisis. We saw credit availability absolutely soar. We saw a huge buildup in housing supply. Then everything fell apart and we saw credit restricted. We saw home builders really retreat from building new units in the markets, and that's contributed to the structural shortage that we're talking about. We saw increased capital requirements for banks, which is actually now contributing to higher mortgage rates. So the difference between benchmark interest rates, like on the 10-year U.S. Treasury Treasury and the average mortgage rate, which is now about 7%, that spread is also at a record. And that's because private investors like banks are constrained from coming in and buying up mortgage bonds. And so you're really seeing a lot of the fallout from 2008 passed on to this new generation of would-be homeowners.
So I would expect, based on what you're describing, there to be a geographic or a kind of location difference to the changing in housing prices, partly because of work from home from pandemic-related changes. People, to some degree, fewer people need to feel, probably for their employment, congregating in cities. They can move to the suburbs, or they could even move, to another state where they could get more space. So you might see housing prices rise in those kinds of neighborhoods or in those kind of places. So prices rising there because there's more competition, but then maybe falling in city real estate markets. That would be my fingers crossed. I live in Washington, D.C. I would love prices to come down a little bit. I might finally buy a home. But my understanding was previously the supply of new houses, like in a place like D.C., is just the supply is so constricted that it was pretty inflexible. So what phenomenon, what impact could work from home be having on this? And will we see kind of regional or rural versus suburban versus urban kind of difference here?
Yeah, I mean, that is certainly the expectation from a lot of housing experts. The idea here is that the places where you've seen the most froth in the market might actually be the most vulnerable as interest rates start to rise. And this is also where you have to start thinking about the general economic outlook, right? So I saw Moody's, for instance, yesterday. Their chief economist was talking about how they're predicting a 10% drop in house prices, but it could be up to 20% if we actually get a major recession. And again, if you think of places like San Francisco, we know that house prices in San Francisco have been pretty frothy for the past few years. And the tech sector, again, San Francisco, a lot of tech workers are living out there. The tech sector is one of the most vulnerable to interest rate rises as well. And we've already seen a number of layoffs, wages going down for tech workers. They're some of the most hardest hit from interest rate rises so far. And that, again, is heaping pressure on that particular locality. And so if you consider, you're going to have to look at almost city by city, but you're also going to have to look at almost sector by sector. Who's actually living in those homes? Are they in industries that are most exposed to a potential downturn?
I just want to follow up on that earlier point you made about private equity. That ProPublica investigation showed that private equity firms account for 85% of Freddie Mac's 20 biggest financing purchases in this sector by a single borrower. And I talked in a radar last week about how the New York Times and some other institutions do seem to try to be creating some slippage between the idea of a mom and pop landlord that earns a couple of extra properties in addition to the one that they live in, and individuals who own organizations, corporations that own dozens, hundreds, thousands of homes, and are really basically have swooped in after the pandemic and really bought a lot of properties as costs were down in those first days of massive unemployment, et cetera, et cetera, et cetera. So that reality combined with the supply crisis that is ongoing, I'm having a really hard time understanding how there are parallels to what happened in 2008 and what provoked that particular crisis. I don't believe it is that you're saying that there is a there's been a lending, people have been given mortgages that they can't afford, and that was a precipitating cause, these coercive, manipulative mortgages. That doesn't seem to be what's happening here. So can you help me to explain, understand that dynamic?
Sure. So just to make this absolutely clear, it is a different environment to what we saw pre-2008. So credit availability is nowhere near the levels that it used to be. Inventory is structurally short. Banks are more restricted in what they can and cannot do when it comes to investing in mortgages. Now, the big factor here, I really think, is inventory. And, you've been talking a lot about private equity coming in and scooping up houses. That does take some things off the market, turns them into short-term rentals. We've been talking about single-family owners, people who have seen their stock portfolios, their real estate portfolios all go up over the past 5 years. Many of them have purchased additional houses for that rental income. And then the other factor that's going to come in as interest rates get higher is something called the lock-in effect. So most Americans have a fixed rate mortgage now, so they're not as exposed when interest rates start going higher unless they decide to sell and then take out a new mortgage. And the vast majority of people who locked in a house at something like 3% last year, I do not think are going to be that inclined to sell now and potentially take out a mortgage at something like 7%. So unless we get a wave of really distressed sellers on the market, it's almost a certainty that inventory is going to remain pretty tight. And that's going to help put a floor under prices.
Yeah, that makes sense. Which is why it's just difficult to understand why there would be a prediction that prices would fall at all. It seems like wishful thinking, especially for the
It depends if
millennials in
you're
the
a
crowd.
homeowner or not, right? It depends what side of home ownership you
Yeah.
sit on. But what I will say is,
Right.
I saw the Moody's forecast this week. They're forecasting a decline of 10%. There are plenty of other people out there who have something much more moderate in their estimates. So Morgan Stanley, for instance, is looking at minus 3% for 2023. But again, a lot of that depends on what happens to inventory and what happens to the wider job market.
Bring those prices down, I say. Thank you. We'll have more Rising right after this.